Recording. So today is Wednesday, April 2nd. This is the 11 a.m. section. And what we're going to do today is give you a chance to kind of practice the process for doing evaluation, which is kind of like your homework assignment for Monday. We're just going to kind of do it together here in class. But before we get to that, just any general questions about anything? Right. Opening up the floor. All right. Does everybody have their kind of working models? And are most of you or any of you in the classroom, or are you guys at home? What's kind of the status here? If you're in the classroom, can you give me a reaction, like a thumbs up? Just kind of get a sense of who's actually in the lab. Three people, 4, 5, 6. All right. So again, for the people in the lab, you can probably, and this is probably ideally better that you do this yourselves. For the ones at home, I can give you some screenshots to help you do our in-class practice today. But let me just see, people put something in the chat here. Some of the fields yesterday were not named the exact names as the friendly names. I was wondering if those are correct or not. Excuse me. So again, back to what I call the friendly name, those can change company by company. And so therefore, that's why column A is not the one you want to match. What you want to match is column B, which is the database field name. So regardless of what's in company A, if the database field name matches, then that's the field that we're using in our model. And so that's what you have to check upon. So Dylan, when you're mentioning that in the chat, that's what's key. And that's what I said, as you went through, you might have found one or two of them where you could find the database field. Initially, you have to use the friendly name to find it. Once you find it, it's that database field that's what we're keying on, just so we're all making sure we get the right data. Great. Any other questions or challenges so far? All right. Well, I haven't done this company either. And we're going to kind of do this together. But if you saw the news this morning, pop it up here. Tesla's sales dropped dramatically last quarter, and specifically 13%. And obviously that's affecting their valuation. And so I thought it'd be interesting to do Tesla and try and see if we can figure this out, because they are in, as you can see here by the chart, no longer growing. There's a big delivery slump. And for them, deliveries equal sales because they're selling essentially direct to the customer. So essentially their big preview, their sales are going to be down in the first quarter as well, which means they're not going to make as much money as we thought. Obviously, people are redoing their evaluations. So we might as well practice doing a valuation of Tesla. So right now, they are trading at 263 and change, down about $5 a share. And so let's go ahead and start out by working through our process. See if today we can do an as is, a bull, a bear, and a target for Tesla. Okay. Well, let's at least start out with the as is. So the first thing that, if you're reusing the model, is let's go ahead and grab some screenshots. So what I am going to do is share my entire screen again, so you can see kind of both windows as we work on this simultaneously. So hopefully, if I can get this right, on one side of my screen, I will have Bloomberg, and the other side of my screen, I'm going to start with the as-is model that we had done and finished up last week for BMW. Anytime you use any of the BMW models, it doesn't have to be the as-is, just happens to be my preference to start with that one. But nonetheless, go ahead and share the whole screen. All right, so hopefully you can see Bloomberg on the right and models, Excel model on the left. Okay. So we're going to start out with some screenshots. So as I said, you're going to need 4 screenshots for your assignment. So let's start doing the screenshots now. So screenshot number 1 is we need a DES screenshot of Tesla, because this is going to be our as-is price based on the screenshot. So right now, take screenshot, save. And I'll call this my Tesla DES, because it's also going to be, again, the price at the top of that DES screenshot is going to be our as-is price. And then here is the shares outstanding that we're going to need. Screenshot number 2 is we're going to need a WACC. And right now, Bloomberg is estimating Tesla's WACC at 13.5%. A lot of volatility there. So we'll go ahead and save that. TSLA WACC. We're going to need the EEO. So I'll grab that. And we're going to need a tax rate. So we're going to check out the guidance. So GUID and see if Tesla's giving any tax rate guidance, which if they were, we would take a screenshot of this, but apparently they're not. So we're going to have to go elsewhere. So when a company, as I said, doesn't have tax rate guidance, typically this is where we will go to BRC. All right, we'll check the analyst reports. So if I look at our BRC right now, see JP Morgan reports, there's one way down there. Let's see if Barclays has something for tax rate. So I'll open up the Barclays report. And just search to see if there's a tax rate here. Nope, not in the Barclays report. Let's see, who else do we have? Mizuho. It's Global Autos. What that? Wells Fargo. All right, so Wells Fargo looks like they have something in their model. Just in this section. So where's the zoom? All right, what are they using in their out years? Looks like 25%. That's kind of tiny, probably on your screen, it's even tinier. So they're using 25% as a tax rate. So before I go any further, I'm just going to go ahead and put into ratios. So what I'm going to do is I'm going to go File, my BMW model, Save As, and we're going to call this the Tesla as is. And for tax rate, 25% is already in here, so I'll leave 25% alone. All right, so those would be the, well, 3 screenshots, didn't have the 4th, and we're using, which we would put in our bibliography, that we use the Wells Fargo analyst report as to get the tax rate, okay, in our papers. So we got kind of our core data that we need other than the model data. So the next thing is we go to FA. And then you'll go to the template that you created for the model. And again, we want to have 6 years of historical data in this exact format with these exact cells. So again, back to settings, you should have already done this. Make sure number of periods defaults to 6, not 10, and make sure that none of these 4 boxes are checked. Okay. And then once you do that, in the lab, make sure you also, before you hit the next button, do the Excel with Bloomberg or Bloomberg with Excel add-in, right? Load that version of Excel so that you have the add-in loaded, because otherwise when you get to the export, it won't export otherwise. So that we're going to do next, we're going to export to Excel the current template. Now remember, you are actually working in the cloud. Or sorry, on those machines, which is essentially kind of like the cloud, because those machines are not your computer. So if you're working in a lab, you'll need to then get this file to you, which is either going to be through email, thumb drive, or something else to bring it to home with you for assignments, or put it in your Google account or something. But before you do, as I said, when you export this data, remember 2 things. 1, these are not numbers. Look right here. These are Bloomberg database lookups. So they're displaying as numbers, but they're actually technically not numbers. So if I save this file and I leave the lab and I open it, it's going to be garbage. It will error out. It won't show anything. Okay. In fact, what I need to do is 2 things. You'll have to do this every time you export the data. Select the whole worksheet that you just exported, copy it, and then paste special values. And so what that's going to do is it's going to take all those formulas and just replace them with the actual numbers. Now you can leave the lab and those are numbers in there. Okay. The other thing is these long dashes. All right, we've got to get rid of them. They're essentially zeros, and Excel does not like this in any formula. So we'll start to error out our model. We'll refer to a cell that has a long dash in it. So simplest way to do this is to copy it, find and replace. So find, paste the long dash, replace with zeros, and then replace all. So there's 48 of them. Now you can do it 1 by 1, but it's annoying to do it 48 times. So replace them all. Okay. And then save your file. So file, save as. And this is going to be this in my downloads folder. This is my Tesla data. Okay. So I'm going to close that. That's my Windows. And I'm going to go back to the Mac where I have my formerly BMW data. It's opening up again. Which I've now renamed Tesla, but I got to update this to have the Tesla data. So I'm going to take the file that I just downloaded and open it. That one. So now I'm on my Mac. And notice didn't error out. So once I have the data file here, I got my formerly BMW model over there, which I've renamed as the Tesla as is. I select all that data. I copy all that data. I select the whole worksheet, because you want to make sure it's doing everything row by row, cell by cell. And again, paste special values. Don't copy paste. It will cause you problems, especially when you're copying and pasting across worksheets, because it'll create links to those worksheets. Every time you open up your model, it's going to say, where's this other worksheet? Yada, yada, just copy the numbers. That's what the paste special value is. It's just copying the numbers, right? But nonetheless, all this data is now in here. This is now Tesla's data, right? But remember, we're kind of in a hybrid mode because we still got some of BMW's data in here as well as we are working on Tesla. Somebody said in the chat, do you mind showing how you exported the Bloomberg file as an Excel file again? So again, in Bloomberg, when you're in the model, okay, there's under FA custom, in your model template, export to Excel the current template. Okay. Don't do it as a PDF. It's not going to help you. Don't do it as a custom report, current template. Right. And then when you do that, it should send it to Excel. But again, make sure you have the Excel with Bloomberg add-in. You'll see Bloomberg at the top of your Excel in that menu. If you don't see Bloomberg up here, you don't have the add-in loaded. And so it won't export. It'll just be garbage. All right, now that we've put the Tesla data in, we need to get this ready to do the as-is valuation. So the first thing is Tesla's last reported year right here is 2024. So we'll go to assumptions. Last reported year, make sure that's 24. Okay. Here's the next assumption. Oh, we've got to make sure our CFI balances. That's good. Okay. So we're probably clean on the data. Back to assumptions. WACC. This was BMW's WACC. Well, over here, back to the downloads. We took a screenshot of the WACC. And today, in our screenshot here, 13.5%. Far riskier than BMW. So 13.5. Okay. Next, I'm going to need the shares outstanding. That's going to be off the DES screen. So for shares outstanding, it's right here, 3216.5. 3216.5. There we go. And the current share price, which at the time of the screenshot, 263.63. Okay. And then I might as well go ahead and do the EEO data. All right, so I'm just going to do it off the actual EEO screen. Life a bit easier. So again, this consensus revenue is Tesla's, that was BMW's. So essentially, I need to, so just start putting them in. All right, for 2025, it's 109,384. For 26, it's 131,927. For 27, it's 156,739. For 28, it's 179,876. And for 29, I have to go over one column. And revenue 219,349. And then come back and go through the EBITDA. All right, so starting in, I'll work backwards in 29, EBITDA 45,030. 28 is 34. 314. And before that, 28016. 22251. And for 25, 16963. But just remember, these numbers are averages, right? So again, these analysts here, these analysts, sell-siders, are doing what we're doing. They're forecasting their models. You can see the actual models in their MODL, and then they're uploading them. And you'll notice that today's 4.2, the models are just being updated this morning based on the guidance. So they've been working through their spreadsheets, trying to figure this stuff out in their own forecasting and coming up with their ratings. So doing what we're doing right now, they've been working out all morning once that new data came out about even the fall in deliveries for the quarter. But nonetheless, you can see here, yes, in the chat. We had to get this data in, so we did. Right. Then we need to go over the ratios, right? Very important. If we change any of these in yellow, they're carrying over, right? Oh, and probably for assumptions, I'll start with my 3, not 0, 3% in my default. Solve for the G and the as is. All right. So now we need to have more realistic long-term numbers, right? So we didn't really change any of the balance sheet numbers. Those are fine, being the balance sheet, and the productivity stay in a similar range to where they are now. So I'm not too worried about the operating balance sheet ratios. Revenue growth rate, obviously 2030 is not going to be 0. So I need to at least put in something reasonable. So for now, I just have it equal to 2019. And same thing for EBITDA margin. That's that perpetuity EBITDA margin we had changed for BMW. Notice their EBITDA margins are much higher. Okay. So again, if I just, as a starting point, equal the previous year, to something a little bit more realistic for growth rate, EBITDA margin, 5, tax rate, if we changed anything else here. Okay. So those are kind of like the key assumptions as a starting point. So back to, what is realistic here in the as is? Well, as I said, we put in the tax rate. So that should be fairly realistic. And the analysts are probably around that. EBITDA margin right now, expected to be around 20%. Even if we continue that in perpetuity, they're growing in 2030. So now we can kind of do a little bit of a mini EIC and see what's going on with Tesla. So I'll come back over here and I'll look at my BICO. All right, so right now, highlight that the analysts are feeling that the first quarter is a, drop off from Europe, China, which is causing challenges too for them. And obviously the political things that are going on, but the analysts think that this is currently short term and will rebound starting next quarter. So obviously they're focusing on cost cutting. So essentially, I think that this could be a rebound in the Model Y. They think that some of their energy-driven opportunities could be valuable, whether it's solar panels or charging stations, self-driving, is good, and they keep promising these robo taxis that haven't technically shown up. So I think the analysts are probably thinking that might eventually be there. And then energy storage. Okay, haven't gotten the higher gross margins yet. But kind of baked in here is the idea that Tesla is going to recover. So they do think that these margins are going to go up, although I'd be curious to see whether all the analysts, as they update their models this morning, fall in line with that view. So I don't think 21% is realistic in 2030, by the way, for revenue growth, only because law of large number effects. As you get bigger, it's harder to grow at the same rate. So, and you can even see this on the income statement. When you're growing between 28 and 29, just for dollar's sake, they're already a $200 billion company, right? So 20% growth on top of that is $40 billion, all right? So, that year they only grew $20 billion. So inevitably, and this is why the book talks about, it's hard to maintain high growth rates long term. They tend to regress towards the mean. And one of the reasons they do is just because the bigger you get it, the harder it is to continue on those same percentages. So if nothing else, as they get bigger, these percentages are going to start to come down. That's just natural. So how much they come down, I don't know, but I'm going to at least start with maybe something like 15%, 10. Now, obviously, the share price isn't doing much, whether I play around with its margin or growth rate, because the real value is going to be that the market still expects a lot of long-term growth out of Tesla. So it's going to be the G that's going to drive the share price. So this is, again, I need to match the current share price with the model. So this is where hopefully I can get GoldSeek to work this time. This is where GoldSeek's going to come in. So what I'm going to do is I am going to go to GoldSeek, and I am going to set sell the share price sorry, this is one of the things I should probably do. Make sure in my DC evaluation, market price, shares outstanding, owned by public. All right, I need to get rid of this. That was only for one time BMW issue. So I'm not cutting that in half, just making sure. So it says 55, and on ratios equals 55. Make sure I'm referring to the right one going forward, because remember, we had to do that weird thing for BMW. So this is, most companies won't have that. Just make sure that your model share price is reflective here. We're not cutting things in half anymore. So equals D31. So back to ratios. I got to get my 55 to equal the 263. So this is where GoldSeek should help us. So tools, GoldSeek. So I'm going to set sell the price to the value I want, which is 263.63, by changing the G. And hit OK. And it's going to iterate and find a solution. And the solution is a G of 12.5%. Pretty high G. And so therefore, that would get my model to balance, 263.63. So there is the Tesla as is. And for those of you following at home, what I'm going to do is open up Elms. I'm going to go to the Files folder. I'm going to create a new folder, which we're going to call Tesla. And in that folder, I am going to upload the data that I exported and those 3 screenshots. So if you're watching this video later and you're trying to replicate this yourself, you're not happen to not be in the lab, then you have the data. But remember, you're going to have to go to the lab, hopefully today, if not soon, because you're going to do the exact same thing for your homework assignment that's due on Monday. I'm not giving you that data. You have to get the data, which means you have to be in a Bloomberg terminal to get this data. Anyhow, back to this. Questions about getting to that price, what I changed, what you probably should have changed with me. Or anything else. What did I do with the DCF sheet? Okay, so make sure, because remember in the DCF valuation here, we had some weird stuff going on with BMW because I told you half their business was owned by a family, half was public. So we kind of split the share price in half, right? And the way I had done it is I think I was actually referring to this cell, which is the half of the share price, as opposed to this cell, which was the total share price, as a way to get to the model share price. So I got to undo that. I can't divide by 2, right? So just to make sure I got rid of these 2 cells, just clean. You don't need that in your future models. And then secondly, back to here, just then take that cell equals that cell, just clean DCF. I think I was at 50 something. And then I just goal seeked the 12.5% to get them to match. Because basically what we're doing is, if you think about key value drivers, and I'll go back to our formula, which I think is actually here on the DCF tab. This is the long-term value, the continuing value, and most of Tesla's value, and like other companies, is long-term. Like they're getting 18 billion of value, operating value in the next 5 years, 800 billion long-term. That 800 billion is based on this perpetuity. So what are the key drivers of the perpetuity? Companies long-term, got to get the WACC right. All right, we didn't change the WACC. So it's got to get the growth in the ROIC. So we are making an assumption in our process. I don't want to kind of be explicit about this. The G is very sensitive. Okay. Notice what happens to the share price if I go from 12.5 to say 10% G, which still seems like a crazy G, but the share price is $101 a share. It's less than half because the compounding. And so when you get to really big G's, slight changes in G can have dramatic impacts on a share price, right? Much more so than slight changes in ROIC. So it's easier to forecast ROIC long-term than G. So the process that we are following, undo this, is we are basically putting everything else in, revenue, EBITDA, tax rate, so that, and we already had the balance sheet ratios. So we're basically forecasting all the components of ROIC. So we're forecasting an ROIC, and then we're solving for a G. That's how we're completing the as is. And 80 to 90% of the time, that will work. Okay. So our process so far is, and this works pretty well for most mature companies that are profitable, is that we'll kind of forecast in the key value drivers all the elements of the ROIC and then solve for a G, okay, in the perpetuity G, because that's the one that's most sensitive. However, every now and then, okay, you get to this perpetuity period, and the numbers that you forecast, the company's got a negative spread, right? But the company still has value. And I'll give you a good example of that today. Look at a company like Moderna. MRNA. If you look at Moderna and you look at their EEO, for the next 4 years, 1, 2, 3, 4, their EBITDAs are negative. And even into 2029, they don't make money in the next 5 years. they lose money every single year. Yet Moderna still has a positive share price and a market cap that says they're worth $11 billion. So how are you worth $11 billion if you don't make any money? Well, I'm telling you, it's all about the future. That there's a bet that the market's making that at sometime longer term, year 6 forward, they're going to turn it around and they're going to have a positive spread. That's the only way that you can justify the share price, because there's no data, even historically or in the next 5 years, that say that they're worth anything. They should, pack it up and go away. But they're not, because the investors have a belief in that future, and they have, so the spread has to turn positive or they can't have any value. So if you're valuing a company like Moderna, what we would actually do is we would estimate the growth and say, okay, they're going to probably grow at this rate, and then solve for the ROIC and say, what ROIC must the market be using to justify this $10 billion valuation, considering the fact they're not making any money in the next 6 years? So we have no way, even in the near future, to estimate what that ROIC could be, right? Now that's an exception. That's more rare in valuation, but things that you might run into. But nonetheless, it makes it a little bit more troublesome, because then you got to estimate the G. And as I told you, that method is just more volatile, because slight changes in G can have huge impacts on the share price. 2 points in G was $150, $160 a share at Tesla. So it doesn't take much. So that's why our process is do everything right, solve for the G. But that's the less bad process, because we're all dealing with the future. Again, pause. Make sense? Questions, comments, concerns about any of this? As the people following along, were you able to get to this price? 263.63? Any challenges? Great. Or close to it? Yeah.
My DCF valuation is way off, but I think that might be my problem, not your problem.
Well, just as I said, the most common occurrence, assuming your model's right, is that there's some assumption lagging from the previous company, in this case BMW, that's hanging around. And I'll give you one of the common ones is this. If we had left 12.5% in there, or 12%, whatever it is, 12.5, 5. I think there's something wrong with my keyboard. 12.5, because that shouldn't be 5. That should be the previous year. Then you're going to get a very low share price. And so that's what I said. That's why it's very important to remember, you changed assumptions. Those assumptions will linger when you have a new company. And if you don't update those assumptions, you could get some real problems with your valuation. That's why I like to just start out with an equals a previous year. Overwrite what I did. Just kind of get it back to a baseline, and then make adjustments, because you're less likely to have that kind of lingering assumption in your model. And that's not just for valuation. That's just anytime you're using a reusable model. It's a common issue. That's why I told you, as a better practice, it's important to minimize the areas where your assumptions go in, and to highlight what assumptions are changed. Because if I had this whole sheet in white, good luck trying to remember which one I hard coded, which one was a formula when you're trying to update them all. So just this is where the better practice comes in. So I bet that's probably what your issue is.
Thanks.
Other questions, comments? Everybody get there? All right, so now is the fun part. We kind of know some of the issues that are going on with Tesla, and it doesn't take much from reading the headlines to see what's going on, because you add on all that, the political ramifications of the burning cars and the protests and everything else, which is ironic, because the people that are doing that are Tesla's base. Like, if you want to bring politics into this in the US, like, Tesla's customers tend to be more on the progressive Democratic side. And yet that's the ones who Musk seems to think are evil people and doesn't like anymore. So he hates his customers, which is ironic, because he needs those customers in this transition. So long story short, He's not helping himself in Europe. China doesn't care about him anyways because they're more interested in BYD. So there's a lot of headwinds right now with this company, and we got to figure this out. And one of the other things, as we get into our bull bear, I want to show you. So let's go back to Tesla. It's back to the analysts. So the analysts, which are currently updating their numbers right now, create this EEO. It's the average of all the guesses. I'm going to take revenue as an example. Revenue for 2025. Highlight it in Bloomberg. That'll show you the range of guesses. Okay. So right now, 2025, which we are in April. So we're 3 months in. And the average guess is 109 billion, but the low is 93 and the high is 128. Think about that. That range of guesses amongst these 54 analysts is basically 28 and 8 is about 30, almost $30 billion between the high and the low, rounding off, right? So 30, what's that, 35, 36 billion? So think about that. That's this year. So what it's saying is there's a lot of uncertainty, even about this year, what the sales are going to be. And there's probably some people think that that decline in the first quarter is not a blip. And there's others like it is a blip. And that's what the bull and the bear is going to be really about. Go out another year. That 131, look at that range in the pop-up box. 108 in the low end, 164 in the high end. Look at 2028, 179 billion, 128 on the low end, 276 on the high end. Think about the range that they have for Tesla. There's just a lot of uncertainty. That's why the stock price has been so bouncy on a roller coaster, because people just don't know. There's no certainty here. And if I go back even 5 years, I mean, their share price doesn't look like a straight line because there's a constant fight between the kind of the bulls and the bears over how big Tesla's going to be. And it doesn't mean they're not going to grow. It's just, they don't know. They don't know. They're putting in their guesses. But obviously, you got to interpret this data point. And you think about your biases. Is it recency bias that we're having that's causing us to want to, think it's going to be hell on earth for them? Or is it really a signal that there's a turning point in their stock? And that's not an easy answer to make, but that's the calls that have to be made. So I turn it to you. We got to do a bull and a bear. Let's start out with the bear. And you tell me, how bearish should our bear model be in the next 12 months? So I'm going to go to here, File, Save As from my As Is, and we're now going to talk about the bear. So what are your thoughts? What should we change and why about the bear? And again, the goal of the bear is the pessimistic scenario of what they'll be trading in 12 months from today. What would happen long term to these numbers and why? Where do we start? Who has some thoughts?
I feel like their inventories are going to be higher because they're going to be selling less cars.
Well, but if the inventories are higher long term, wouldn't they just adjust production?
In this next 12 months, though, like,
But do you think in the next 12 months they might have more inventory? Okay, so we could do that. So we can come here to inventory 2025 in our bear. 12% of a year is probably 10% is 360 days. It's like probably 40 days worth of inventory of Teslas right now. So what do you think is going to happen in the inventory? If they got 40 days now, how much more are they going to have if sales decline? Give me days, we work out a percent.
Maybe like 120.
Oh, you think it's going to triple? Wow. Okay. So go from 12 to 30. Okay, well, that's gonna take a big dip out of the cash flows if they can maintain that level long term. But if they go back to 12 after that, then it'll be minimal. So if it's a structural change, which I don't think it would be because they would just slow down production, it could really hurt the share price. But as a one-term blip, yeah, it'll hurt them, but not that much. A penny a share, basically, in the grand DCS things. But we can put that in there. What else might we change? In the bear model. Any other thoughts? Would you change the revenue growth rate? Would you change the margins? What about the Trump tax cuts? Let's see, what does it say? Revenue growth would decrease. Okay, people are moving on Tesla and maybe towards BYD. Tariffs might hurt their revenue, which could affect, again, really good call out on the whole automobile industry and the impact of tariffs. All right, so again, let's think about this. We're going to be changing short-term growth and probably margin. So I know we were referring to in our default model these assumptions, but in our bear, we might want to override those assumptions, put in some additional assumptions. So I'm going to make those yellow again, because I'm going to highlight to myself that I directly inputted those. Okay. So how much growth do you think they're going to have this year? We're down like, was it this quarter, 6-8%. What's the year going to look like? Are they going to be flat? Are they going to be negative? This is the bear scenario, remember. Probably not going to be growing. So how much are they going to shrink?
I would say just like throwing it out there, like half of what it is right now. I think it was 12% for the revenue growth rate. So just cut it in half to 6.
So start -4. Okay. Now, what's your view on 26? Do they recover in the
I
more
think,
pessimistic scenario?
yeah, I think they still have a revenue growth rate, but like that's positive, but it would definitely be like maybe single digit, maybe like 9% or something.
Okay. And maybe we trend all these down as well. So this is maybe, 10, 10. So this is on the lower growth track. All right. Well, that's a much lower share price. Now, talk to me about margins. They could take a margin hit.
Yeah, I guess like following the same trend for the revenue growth rate, yeah, they would have lower margins too. So
So that's the
probably,
question. Are they going to go back to where they were last year, which is probably the low point of the last 5 years? So maybe 13%. Musk is pretty good about being ruthless about getting rid of people as his costs go down. I think he's proven that. So yes, it probably won't be 1-to-1, but less revenue, less sales, less production, less people. So let's put it at 13. Do they recover their margins as they return to growth?
no, I think like you mentioned, like Musk is pretty good with that. So maybe we'll just keep them more or less the same for the
I think
margins.
it'll go back to 17%, which was an improvement,
Yeah,
closer to
yeah.
13.
Let's just keep it how it is right now. So at like around 17.
Okay, this is the bear scenario, remember.
Oh, okay.
How about
Okay, yeah, I
15?
guess then
Let's go to
15.
15.
Okay.
So they'll improve margins, but they won't be as high as they originally thought. And we have to state these assumptions. Whether you like it or not, you're going to have to adopt a point of view here. You're going to have to basically give some justifiable assumptions. Well, we just slashed the share price to 63. And oh, by the way, I think I saw this. When I looked at the ANRs, let's look at the lowest target share prices. All right. The worst target share price is Gordon Johnson, who's like they're worth $25 a share. But you got JP Morgan, Wells Fargo putting them down in the half range. So, maybe a little bit less pessimistic than this, but there is a pessimistic scenario, and that's their baseline, by the way. The target for some of the bigger banks recently, based on what they're seeing with Tesla recently. Matter of fact, Wells Fargo came out this morning with a 130 price. That's a big red sell. And you can see 13 sells versus the price where they started today. And ironically, people are buying. So I think we've kind of butchered this pretty well. So if I want to get closer to where some of these numbers are, maybe I say, okay, maybe not as bad, but at a point of margin here, 16. Notice the individual years aren't going to matter as much. What's going to matter more is that perpetuity period that I changed. So we're at 80, but the other problem is this one. This G of 12.5% is very high. So it just says they're going to keep growing at 12.5% a year forever. That might start to come down. So even if I made it 11.5%, 11%, then I'm back to $50 a share. So I'm saying that in a worst case scenario, if people really start to think of Tesla as not a growth stock, then you don't want to own. No matter what's going on. The retail investors, mem stock, whatever, they're not going to be able to basically handle the flood of investors wanting to get out. And that would be a real challenge for Tesla. But there are some people who see this as a buying opportunity. Tesla's on sale. This short-term blip and everybody selling is an opportunity to buy. So I'm going to save this as my bear. I'm going to go back and open my as is. And I'm going to file, save this as my bull. So again, now I am trying to think through the optimistic scenario of Tesla. So what could go right? So what would you guys say? What's more in the optimistic scenario? What gets you closer to these numbers over here for Tesla? And with the issues that we were talking about.
No, we first mentioned the revenue growth rate for the bear. But maybe for this one we could also look at the tax rate too. The tax rate kind of high in our forecast. So
All right.
we lower
So one,
it.
so let's handle a couple. One, tax cuts come through, tax rate goes down. Trump's been talking about 21% for corporate tax rate. They still got some state and local, so maybe 25 becomes 22. And boost a little bit of a share price. So lower taxes, assumption number one, but that's actually pushed through structurally for corporations. What else is there? Do you think the revenue growth is going to be even higher? Higher in the out years. I mean, we're already talking about peak margin in 2030. I mean, the highest they were ever is 21.4 in 2022. So say 21.4, they get back there. 300 a share. So squeeze out a few more costs, maintain their price premium. And so the only way that they really maintain this long-term growth, and because again, I'm uncomfortable raising this behind above 12.5%, because by the way, you do know mathematically in perpetuity, your G can never be higher than your WACC. So in the cash flow divided by R minus G, the G can't be greater than the R, right? That's a math error. So you're about as high as growth as you're going to see for a company of this. So I don't think the long-term growth rate is going to get much higher, even in the bull scenario, because people are pretty optimistic on them already. So it's really squeezing out a little bit more growth, maintaining that high growth. Particularly, it says that, they hold their own against BYD and do have sales in China, that they do return to growth in the US and in Europe, and maybe a couple of other markets, and that they get some cost synergies. And that gets them to the 300s. There were 300 a share, 322. Okay. And we could be a little more aggressive around the margin, but I'm going to call this my bull. And then finally, Target. What do you think? Like, where do you think that they're going to end up? And again, over here, there's no consensus. So this is now your opinion. Do you think they're going to be about where they are? Do you think they're going to be towards the bull? Do you think they're going to be towards the bear? Like, now's your chance to put in your opinion and explain yourself. And that's the whole point of the target model. So start with the as is, put in your target, make some adjustments, and then make your judgment call. So what do you guys think? Just start out conceptually. Do you think that they're fairly priced? Do you think they're undervalued? Do you think they're overvalued? You guys have some knowledge of what's going on. Where would you be leaning towards? I mean, do you believe that Cantor Fitzgerald is right? Andre Shepard's team, they're pretty bullish. Do you think that Wells Fargo, who hates them, is right? Do you think that Barclays is like, they're pretty close to the current share price? Like, where are you on this company? If it was your own money, what would you do? And by the way, this is an opportunity in the Bloomberg Trading Challenge as you answer that question. But what do you think?
Although I probably wouldn't invest in Tesla because it's like so volatile, I would say the price is probably it's slightly undervalued right now. I think that the price should probably go up to like at least the mid 300s, maybe return back to where it was a few months back, like at some point within the next 5 years. I'm kind of optimistic about like the EVs and just like what Tesla's doing in general.
By the way, the person in the chat, in the bear model, I changed the 12.5% G to a 10.5% G. That would have been the difference. In terms of too volatile to stay away. Okay, well, that's an opportunity, but that suggests some pessimism, saying that you don't see the upside. So you're probably leaning a little bit more on the bear side, that they're the fairly valued or overvalued. You don't think they're going up too much. So we could translate that. So if I go back to the file, Excel, file, open as is, file, save as, target. So what we could say here is, well, maybe this slows a little long term to 12. Maybe this margin comes down a little to, I don't know, 18 long term, 19. No, it's going to have to be around 20. Either way, you start cutting a little bit of margin, slowing down that growth, it's a sell. Like I'm in your camp. I do not want to personally own Tesla. I think when you kind of take out all the noise of this conversation, here's a company that it's an entire bet on growth. And that growth gets them an economy of scale and high margin. And if that growth slows and that margin is not achieved, then that valuation is going to fall like a house of cards long term, no matter what people say in the short term. And you want to say you want to bet on Musk. Musk is barely a part of Tesla anymore. He's off doing other stuff, which has actually been one of the biggest complaints. Like, you're the richest guy in the world because you invented companies. Work on the companies that you invented on. Don't get bored and go do other stuff. Like that. So that was the whole thing. For years, people bet on him, and they're still betting on him. But he's not running the company anymore, and peripherally involved in the company. So are the people there the ones that are going to figure this out? And maybe they are just, they're going to grow, just not as much. Well, that's not a high valuation. So 10% below 263, I'm at 182. That's more than 10%. My target's a sell. I would be with Wells Fargo. I would be telling my investors to get out. Take your profits if you got them. Potentially we'll set them aside. We'll look at the company, but there's better opportunities elsewhere that have a whole lot less volatility, because you're just making a bet on a growth that, as I said, to me, I don't think it is a recency bias. I think it is a little bit of a tipping point in the growth, and their growth is going to start to slow. Growth slows, margin slows, sell rating. So I'm explaining all this in my paper, by the way, that you're writing. But nonetheless, that's how my view. You don't have to agree with that. You could be the opposite. You could be the Tesla, go baby go. This is the blip. It is a return to growth. They are going to dominate the world. They are going to be the best competitor. No one can keep up with their technology for self-driving cars right now. They're going to introduce the robo-taxis and be successful. They're going to have the self-driving mode for cars. That's going to be better, and people will prefer that over time. Like, you can put all that in there and come up with a bot, and we'll find out. But that's what you're going to have to do with any company that you value. So today, as I said, I wanted to kind of go soup through nuts through reusing the model and kind of walk through the process and talk through the process. That's what we have done. So before we close out, questions about anything? In my target, this is my target. The only difference in my target is I'm using a 12% G versus a 12.5% G, which I started in the as is. So I slightly lowered the long-term growth rate. It's not like I'm saying they're not going to grow, just incrementally less. And that extra half a point took off a big chunk of their share price. And that's why I said, doing these models is actually very instructive, because you start to realize, like, this company is all about growth. And if anything changes about that growth rate, it's going to have a big impact on the share price. Or this low growth company is all about margin. So if that margin changes slightly, it's all about the share price. So you start to understand what the drivers are of a stock. And so therefore, there's another value in doing these as is. All right. So we went through the process. You have the data to replicate Tesla. Your homework, I changed it for Monday because I told you I wanted to give you a company that balances, and accidentally I found one that didn't. So I changed it yesterday. The company that you will be doing for Monday for homework 10 yourselves is Target. Okay. And I did Target myself, so I do know that you're not going to have any balancing problems. Right. And all 4 screenshots exists for Target. Right. So again, similar to the process, you'll submit the as is, the bull, the bear, and the target model of Target. Hard to say that. You'll make sure you have 4 screenshots, the DES, the WAC, the GUID, and the EEO, and a minimum 500-word paper explaining with context, business context, why you made the assumption changes across the models. All of that Monday, 10 a.m. TAs, again, have office hours over the next 2 days. Please take advantage of that. The lab is open the rest of the day to get your data. Please take advantage of that. Right. If you have any other questions, please let me know. Otherwise, thanks today, and I'll see you guys on Monday. Have a good week.